Amazon just completed its 20-for-1 stock split. If you're like I was 20 years ago, you thought, great, the stock is cheaper. But hang on a second, the stock is not cheaper. Don't fall for that trap. All right, guys, so I'm going to explain you stock splits, and then we're going to go through the Amazon 8 pillars. If you have our software, please follow along and everything. And if you're new to our channel, please share this video with somebody who might find value in it, because there's a lot of things to learn out there. So let's go to our 8 pillars, and let's pull up Amazon. We're going to go step by step into our 8-pillar process. All right, guys, so Amazon split adjusted, 52-week high was 188, which is about 3,700 previously, and the 52-week low is about 101. The stock is currently trading, according to our software, at 121, so 20% higher than its low. It is a $1.24 trillion company. This is the first step in showing you that the stock is not cheaper. The market cap is the same. All a stock split does is it divides the share price into 20. Every person who owns a share now gets 19 more shares. So you might sit there and say, oh, I got more shares and the stock is cheaper. No, what you do is the total value of your shares stayed the same. That is the big key on stock splits. And that's why I wanted to go through this right here and explain that. Stock split changes zero fundamentals in the business. The revenue is the same. The profit's the same. Cash flow is the same. Now, the per share ones have changed, but overall, it is being divided amongst 20 times more shares, which is why the share price has decreased. This is very, very important. I remember being a sophomore in high school and believing my teacher when they said they wish they owned Nike stock, but it was too expensive. What they were saying was they couldn't buy enough shares to justify paying $50 per share for the stock. This is 1,000,000% factually incorrect. You must remember that and understand that. Once you understood that, you're going to have world of investing is going to be a lot easier to do. All right, so first pillar in our 8-pillar process. We want the 5-year PE ratio to be under 22.5. It is currently 83, so almost 4 times larger, okay? What this means, if you take the profit over the last 5 years, add it all together, and divide the market cap into that, you're at 83. That's pretty expensive. Does that mean you should avoid it? Not necessarily. More on that to come. Pillar number 2, we want a 5-year return on invested capital greater than 9%. Right here, very front page of our software, 5-year return on invested capital of 3.2%. So this tells me that Amazon is not doing a great job reinvesting the money that's within the business through debt and equity. Now, again, guys, for those of you who've watched us before and for those of you who are new, every individual 8-pillar does not make the stock a buy or a sell. The 8 pillars are a tool for screening stocks to give you an overall picture of the things you have to understand better going forward. Pillar number 3, we want revenue growth over the last 5 years. So we go to the income statement. 5 years ago, we had $193 billion. The last 12 months, $477 billion. Massive check mark there. Pillar number 4, we want net income growth. So again, we scroll down on our software to the net income line, $3.94 billion 5 years ago, $21.4 billion last year. That is incredible. It's 5 times growth. Pillar number 5. Now, guys, this is the important one involving shares. Pillar number 5 is a silent killer investments. We want the shares outstanding decreasing. Now, remember, this does not have anything to do with the stock split at all. With a stock split, it makes all the previous numbers adjust. When a company is just issuing shares, they are diluting you as an owner. They are now just adding more shares to the market, and this is very different than the stock split, and it's splitting up the revenue and profit amongst more owners. So it's like you and I own a business together. We're 50-50 partners. I decide, you know what? I'm going to bring somebody else in and give them the same number of shares. 1 share for you, 1 share for me. Now I'm adding 1 share for that person. Now we're splitting the profit 3 ways instead of 2 ways. You now own 33% of the business instead of 50% of the business. I've diluted you as an owner. That's what increasing shares outstanding is. We scroll all the way to the bottom of the income statement, $9.54 billion to $10.18. So it's not a huge increase, but they are still increasing the number of shares outstanding. Again, not big, but I would argue that Amazon is being smart doing this because the stock is so expensive. They're sitting there saying, listen, we can either raise debt and have everybody be punished for that, or our really, really expensive stock, we can sell more of the market because everybody wants it and use that to fund our operations. Seems like a more logical choice. Remember, guys, if the company is doing that, they're basically saying, you guys are buying our overpriced stock. I'm fine with that. We're going to keep giving you overpriced stock in the market and we'll take the cash in there. That is an issue. Pillar number 6 has to do with the debt of the company. what we want to do is we want to go back to the main page. And on this main page, I make it very easy. I show you a 5-year average free cash flow, $8.5 billion. Now, to be able to easily handle long-term liabilities, I take this $8.5 billion, I multiply that by 5. That equals $42.5 billion. It's actually $42.6 billion. I want our long-term liabilities to be under $42.5 billion. So I go to the balance sheet and I go to the most recent quarter and scroll all the way to the bottom, $137 billion. That's a lot of debt. Guys, debt is a concern for me, especially with this concern of mine. Look at Amazon's gross profit and overall profit margin. Every dollar they bring in extra revenue is only 13.5 cents extra in profit to them. I'm okay with the company having a lot of debt if they have high gross margin and high overall margin. Every dollar they make last year only brought them 4.5 cents of profit. That's a concern of mine. So they're taking on big levels of debt, but what happens if all of a sudden the business falls big time? They're going to be driving a lot of profit down. I don't like that. That is, debt to a company is just like debt to you. Are you more or less likely to go bankrupt having more debt or less debt? Now, I'm not trying to tell everybody that Amazon's going bankrupt. That's not my point. My point is, as an investor, your goal should be to find a great situation in a great company with a great balance sheet. Because as Warren Buffett said, every time he sees smart people or smart companies go under, there's usually one culprit behind it, debt. So just be careful about that. Pillars number 7 and 8 have to do with cash flow. So we go to our cash flow statement right here. We want to look at free cash flow. So what is free cash flow? Free cash flow is cash from operations less your capital expenditures. There are 5 things a company can do with free cash flow. They can pay dividends, buy back shares, reinvest in themselves, pay down debt, or make acquisitions. They can do all of them, none of them, one of them, any combination they want. This is the true lifeblood of the business. So to make it easy for you guys in our software, I added this free cash flow line because this does not exist on other financial statements. 5 years ago, they did $5.3 billion. Last year, they lost $24.6 billion. That's a huge drop. But keep in mind, here is why. They spent $64 billion in capital expenditures last year, which was a record. Previous year, they did 45, and no other year before then was even close to that. Guys, they are growing a lot. So one of your goals should be figure out what they're spending their capital expenditures on. Are they building warehouses? Are they building infrastructure? Are they buying planes for delivery, trucks for delivery? These are all things that might be an investment in their future. Remember, 5 things you can do with free cash flow. One of them is reinvest back in yourself. They may be reinvesting to make more profit down the road, which I'm okay with. Their low return on invested capital was largely driven by this right here. Now, Amazon's been great about reinvesting in their future. That's why we do the 8 pillars, because we want to see the story being told here that might be okay for the future. So our final pillar is we want to use that average free cash flow for the last 5 years and come up with a starting point for market cap. So we take the $8.5 billion and we multiply it by 22.5. And that is 170 and 787 and call it $191 billion. What is the exact number? Let me sit there and see how good my math was. So 8.5 times 22.5, $191.25 billion. Aren't I just the smartest guy in the world? So we want the market cap for the business to be under 191 billion. Guys, it was 1.24 trillion. That's a big X. So does that mean don't buy Amazon? Not necessarily. But I threw a lot of numbers out there at you. For those of you who are new and don't have the software, there's an 8 pillars tab right here. And it shows you all the gives you all the check marks and X's. We only had 2 check marks here. Everything else here looked bad. But guess what? The one thing you have to remember is Amazon is very well known for reinvesting their future. Very well known for that. If I had 2 companies that were exactly the same, and one was growing at 20% a year, one was growing at 5% a year, would you not pay more money for the one growing 20% a year? Of course you would. So higher PE can be justified with a higher growth rate. So the question you have to ask yourself is, can Amazon grow a ton from here? That's where I have questions about this. Now, guys, for those of you who are new to the channel, this might be very intriguing for you. You might have conversations with other people. Please, at the end of this video, please share this video with somebody who might find benefit in learning something about this. But our next step is we're going to use a stock analyzer tool. This has been one of the most popular things in our software. We're going to use a stock analyzer tool. So guys, every investment's the present value of all future cash flow. We don't know the future. We can only make assumptions about the future. The stock analyzer tool allows us to input those assumptions and tell us what we should pay for the company based on that. So your next question is, well, what assumptions should I put in? Well, that's the important part. If I put 100% revenue growth a year for the next 10 years, Amazon's a buy all day. But is that realistic? So now, for those of you who've watched the channel for a while, you know I don't really put much credence into analyst estimates, but it's a good starting point. Here are the analyst estimates for the next 10 years on Amazon's revenue. As you can see, it's growing at slower paces as time goes on, which makes sense. As time goes on, the company gets bigger and bigger. It's harder to grow at faster growth rates. So I like the fact that I'm seeing this trend. But even then, what's the average here? 10%? You know, the good old days of 20, 30% revenue growth for Amazon are probably long gone. Why? They're just so big and successful. What about earnings per share? Well, we have that too. Here is the earnings per share. This is actually a little bit more bleak. Actually, wait a second. Let's see that. So we went from 500 billion to the high side of $1.4 trillion in revenue for Amazon in the next 10 years. For earnings per share, 2.45 per share and 3.72 in 10 years. That's not big, guys. That is not big at all. So even though you see big growth numbers here, it starts off by dropping. I guys also want to remember, Amazon's retail business does not make money. Their profit comes solely from AWS. Amazon Prime doesn't make money, and the retail does not make money. And there are going to be people out there right now going, no way. Go look at their profit breakdown in the company. The money is made at AWS. All right. So let's go in and do our analysis on Amazon. So like I said, for revenue, they're looking at about 10% revenue growth. That's based on the analyst expectations. My experience has been analysts tend to be a little bit optimistic. So I'm going to go low side. I'm going to call it 4, 7, and 10%. So I'm going to start with a low number. Hey, if they grow about with the US economy, 4%. They do a little bit better than that, 7%. If they hit analyst expectations, probably 10%. Now, profit margin. Guys, how do I get my estimates on profit margin? Well, I look at the last 1, 5, and 10-year numbers as we give them here. And I look at that saying, okay, over 10 years, they did 3.7. That's probably pretty much in tune. But I also remember that Amazon didn't make money until recently. So this number is probably driven down quite a bit. So I'll probably go 4, 4.5, and 5%. Then I imagine their margins will get a little bit better over time is my guess. Free cash flow. So guys, here, same thing. I'm looking at the numbers. I'm going to ignore this free cash flow in the last year because we saw capital expenditures really jump up. And I also think that revenue and profit margin and free cash flow should be around the same numbers over time. So I'm going to go with 3, 4, and 5%. So I went a little bit lower on the low and middle ones. Now, PE. Guys, this is where everybody's going to go, Paul, you're wrong. Remember, guys, there are 2 reasons why we have high PEs. One is an incredible moat. I don't like talking about moats because I look at it going, I think people want to over-exaggerate moats. With that said, do I think Amazon is a moat? Absolutely. Abso-freaking-lutely. Second reason, high growth rate. Do we have the high growth rate in Amazon to justify this 58 PE currently? I do not think so. So, for fear of everybody blasting me, I'm going to go with 14, 17, and 20 PE, which I think 20 PE is still way too high. We'll put it in there. And guys, for price of free cash flow, I try to do the same number. Now, for our final entrance, the desired annual return, you can get 9 or 10% in the market. So give yourself some margin of safety and a little bit return, and I'm going to do 12.5%. I'm going to hit the analyze button. Scroll down here, and guys, here's the price. A low of around 20, low 20s, low to mid 30s, and a high price of $60. So it's got a ways to fall from 122. The good news is on our software, I can add it to the watch list. And at $58, maybe I want to pay attention at 65. I notify me below there. So guys, if you like this analysis, please share it with somebody. And if you liked what I did here and want to learn more about how I input my assumptions, I made another video on 10 stocks and how I use a stock analyzer tool to determine a price for them. Please click above.